as commercial mortgage market are things that people had core allocations to that they have a firm understanding of. If you look at the private market, and these are kind of a refresh of what we saw earlier in March, it's again, very, very well understood. It's been a long-standing core asset class for life companies for decades. The market is roughly $400 billion in size, with annual issuance in the $40 to $50 billion per year. The market is still dominated by life companies, using it as kind of a spread arbitrage asset class. Consequently, it's an A3 to Baa3 in credit quality, and that's where life companies get their most favorable return on regulatory and rating agency capital. The maturities, line up very specifically with life liabilities. The belly of the market is between 5 and 12 years. With that said, the market spans from floating rate out to 30 years, depending upon the idiosyncratic issues that both the issuer and the liability stream wants to satisfy. Why do people participate in the market? We can certainly go into the public investment grade market and have greater liquidity. I look at this and I call it the 3 pillars of value. It's spread, structure, and diversification. From a spread perspective, we expect over a cycle that a private market should contribute 35 to 45 basis points relative to comparably rated public portfolio. On the structuring side, I kind of think about this as similar to what you might, the argument people make for bank loans. It's kind of the bank loan equivalent within the investment grade, bond market. Generally,